In a world where change is the only constant, Mo Shamil stands at the forefront, guiding title professionals to not just grow their businesses, but to master the art of innovation. With every episode, you're handed the keys to unlock unparalleled growth and stay ahead of the curve. Get ready for a transformative journey.
Imagine walking into your favorite local restaurant, you talk to the manager, and they are just absolutely glowing. I mean, they tell you they just had a record-breaking quarter for revenue.
They're practically popping champagne. What?
Exactly, popping champagne. But you look around, and the main dining room is, well, it's completely hollowed out. There is hardly anyone sitting at the tables.
Just solely empty.
Yeah, completely baffling until you peek behind the curtain and realize they just happened to host a few massive, extremely high-ticket corporate banquets in the back rooms.
Right.
And that half-empty dining room, that is exactly what is happening in the title insurance industry right now. Welcome to this deep dive where we are looking at the Q2 2026 financial earnings, SEC filings, and strategic briefings from the Big Four title underwriters.
So that's Fidelity National Financial, First American, Old Republic, and Stewart.
Right. And you look at these numbers and they look incredibly strong. But we are going to lead with the thesis right out of the gate here because this framing matters way more than any single company's figures. The title market absolutely improved this quarter, but it is not because everyday people are suddenly buying homes again.
No, not at all. The underlying mechanics of this quarter tell a very different story than the headline revenue.
Yep.
The underwriters found their growth, and in several cases much stronger margins, without a real residential recovery.
Yeah, they really did.
I mean, they got there through commercial deals, a major surge in agency volume, refinances bouncing off a severely depressed base, and aggressive fee profile increases. They combined all that with technology-driven scale.
Mm-hmm.
So if you are an independent title agent reading these earnings reports, and you walk away thinking a residential housing recovery has arrived to save the day.
You're misreading it.
Completely misreading the market, yeah.
Okay, let's unpack this. Because understanding how they actually made their money is the lens through which every single strategic move they make next has to be viewed. Let's look at why that residential recovery is effectively a mirage right now.
Right, because ALTA, the American Land Title Association, they reported a 15% bump in title premiums back in Q1.
Yeah, but we don't actually have the Q2 2026 market share data yet. So if we step back and look at the macro environment, Fannie Mae's June 2026 forecast projected that 30-year mortgage rates will sit around, 6.4% through the back half of the year?
Exactly, which fundamentally freezes the everyday residential purchase market.
Yeah.
I mean, when you have this massive cohort of homeowners sitting on 3% or 4% mortgages from a few years ago.
They're just not going to move.
No, a 6.4% rate creates an immense lock-in effect. People simply cannot afford to move because giving up that low rate drastically reduces their purchasing power for their next home. Affordability remains structurally strained.
Meaning the volume of standard single-family home transactions is artificially constrained. So if the everyday family isn't buying a house, we go back to our restaurant's back room, right?
The corporate banquets.
Right. Commercial transactions are the corporate banquets carrying the quarter. The sheer revenue generated from these commercial files is what actually drove the top line for the Big Four.
And the disparity is just striking when you isolate those commercial divisions. Fidelity National Financial, or FNF, saw their commercial revenue jump 32% to $440 million.
Wow.
Yeah, First American's commercial revenue climbed 34%. Stewart's domestic commercial revenue was up 20%.
Wait, I mean, if the general economy is dealing with high interest rates, how does the commercial sector just bypass that friction? Are there really that many more skyscrapers and shopping malls changing hands right now?
Well, no, it is less about a sheer explosion in the number of buildings being sold and more about the mechanics of commercial files themselves. Commercial transactions carry exponentially higher liability.
Which translates to significantly higher premiums.
Exactly. Higher premiums and fees per file. From an operational standpoint, an underwriter can generate 10 times the revenue on a complex multi-state commercial portfolio deal than they can on a single residential file.
And they don't need 10 times the operational headcount to process it.
Right. It is a highly efficient way to artificially boost the top line without relying on a high volume of individual transactions.
Now, before we start stacking these companies against each other based on those percentages, I want to plant a quick flag regarding how we actually read these SEC filings. Every company in the Big Four defines and presents their title revenue differently.
Yeah, you have to be careful there.
Right. Like Stewart reports their agency revenue gross, meaning the total amount collected before the agents take their cut, while others present it totally differently.
FNF and First American also construct their adjusted margins using completely different line items. So we are examining these filings to identify operational momentum and where these companies are directing their capital. We're not treating this as a strict mathematical ranking system.
Yeah, and we won't waste time untangling their specific accounting definitions from here on out. We just wanted to note that.
Exactly.
So if commercial deals and high-fee files are what drove the revenue, the very next logical question is who actually brought that volume in the door. And that leads us directly to the independent agent and this strange dynamic hiding in the numbers that we are calling the agency channel paradox.
Yeah, the paradox. Because agency volume is up double digits across the board. The underwriters leaned heavily into their independent distribution networks to capture market share this quarter.
Stewart offers the clearest window into the mechanics of this paradox, I think.
They really do. Stewart reported that their gross agency revenue jumped a massive 25%, landing at $377 million.
Okay, if I am listening to this as an independent agency owner, I have to stop you there. If my channel just drove a 25% revenue jump to the tune of $377 million, my immediate reaction is that I am holding all the cards.
Sure, you'd think so.
I mean, I own the client relationships in my local market. I bring the underwriter the volume, and they are completely dependent on me. Shouldn't independent agents feel incredibly secure about their position right now?
What's fascinating here is, from a market share perspective, yes. But from the underwriter's boardroom, you are not viewed as the savior of the quarter.
Wait, really? How are they viewed?
You are viewed as a massive, uncontrollable variable expense. And Stewart's own accounting reveals why. Of that $377 million in gross agency revenue, the independent agencies retained $314.9 million.
Leaving only about, $62 million for Stewart?
Correct. And this brings us to a metric called adjusted title pre-tax income. This is basically the profit a company makes from its core title operations before paying taxes, after subtracting all operating expenses.
Which includes the massive split they just paid out to the independent agents.
Exactly. Because the agents kept $314.9 million, Stewart's adjusted title pre-tax income actually fell 8%, and their profit margin dropped from 8.5% down to 6.9%.
Wow. So the underwriter's revenue goes up, but their actual profitability gets squeezed because they have to surrender the vast majority of that cash to the independent agent who sourced the deal.
The honest takeaway for the independent agent here is that you are highly valuable for generating volume, but you are actively detrimental to the underwriter's profit margin.
That is a tough pill to swallow. But what about Old Republic? I mean, they constantly market themselves as being agency-driven, positioning themselves as the ultimate partner for independent agents. And if you glance at their headline numbers, they posted a 130.5% profit jump. Doesn't that totally contradict the idea that agents squeeze margins?
Not really. That headline number is entirely a base year artifact.
Meaning what, exactly?
Meaning last year's profit was artificially suppressed by a one-time $15 million litigation payout. So making this year's normal performance look mathematically explosive by comparison is just a trick of the numbers.
Got it.
We can completely ignore that 130% figure because it tells us absolutely nothing about their current operational momentum. The broader tension remains the exact same across the industry. Public companies cannot tolerate shrinking margins indefinitely.
No, Wall Street won't let them.
Right. If they are losing profit on the agency side of the business, they have to engineer a way to claw that margin back.
And how exactly do they engineer that? Because, you can't just force thousands of independent agents to suddenly accept a 10% cut to their splits. The agents would just walk down the street to a competing underwriter.
Exactly. You don't claw it back by changing the split. You claw it back by changing the infrastructure the agent relies on.
Okay.
You build proprietary technology that targets the independent agent's core workflows, which brings us to the most critical part of these filings, the margin and artificial intelligence story.
Yeah, let's look at what FNF and First American are doing, because they are effectively writing the playbook on surviving this margin squeeze. FNF pulled in $2.5 billion in revenue, excluding their recognized gains and losses, of course, with a highly impressive 17.8% adjusted pre-tax margin.
Very impressive.
And First American also showed immense operational strength with a 14.0% adjusted margin.
And they are achieving those margins by explicitly building AI into the foundational plumbing of title insurance. We're talking about the search, the examination, the fraud detection, and the settlement processes.
Here's where it gets really interesting. First American is heavily pushing an AI tool called AgentNet Assist, Title Intelligence. They are claiming that this AI can ingest unstructured title search packages, extract the relevant data, flag breaks in the chain of title, meaning it spots missing links in the historical ownership record, and reduce the processing time by up to 30 minutes per file.
Yeah, and to understand the impact of that, you have to look at the mechanics of what the AI is actually replacing here. Historically, title examination involved highly paid human experts doing, stare and compare work.
Staring at screens for hours.
Right. They are reading centuries-old handwritten deeds, cross-referencing messy public tax databases, and manually typing that data into a commitment. By integrating advanced optical character recognition with large language models, the underwriter's AI does that initial extraction and comparison instantly.
And saving 30 minutes per file across thousands of files. I mean, that is a staggering reduction in labor costs.
It's massive.
But wait, practically speaking, optical character recognition and automated public record searches have been around for like a decade. Is this actually a technological leap or just a new marketing wrapper around old software?
No, it is a genuine leap because these models can now interpret the context of unstructured documents rather than just pulling text from a standardized form.
Oh, I see.
It can read a poorly scanned, non-standard deed from 1985 and understand that a specific paragraph creates an easement, then automatically flag that for the human examiner.
Okay. But if I am an independent agent, my entire value proposition to the consumer and my justification for keeping 80% of the premium is that my team does the complex exam and clears the title. If the underwriter software is now doing all that heavy lifting, are these tools empowering the agent, or are they slowly making the agent entirely dependent on the underwriter's ecosystem?
If we connect this to the bigger picture, it introduces a massive ecosystem risk.
Right.
F&F recently named a new president of enterprise solutions specifically for their agency division, tasked with helping agents scale through technology. Underwriters are bundling production software, identity verification, escrow controls, and these new AI exam tools into one unified platform.
Which sounds great on paper. I mean, it gives a small 5-person agency the technological horsepower of a multi-billion-dollar corporation. But there's always a catch. It reminds me of the classic printer and ink business model. An electronics company will sell you a beautiful high-tech printer at a massive loss, practically giving it away. But the printer is digitally locked. You are forced to buy their specific proprietary ink cartridges for the rest of the machine's life, and they can raise the price of that ink whenever they feel like it.
And that is the exact mechanism of vendor lock-in occurring here. If your entire operational workflow, your document storage, your fraud controls, your AI exam tools, and your daily escrow reconciliation, if all of that lives exclusively within one underwriter's proprietary platform, the operational pain of switching underwriters becomes astronomically high.
Because you can't just easily unplug from all of that.
No, you lose the leverage to negotiate your splits because you can't realistically leave without entirely rebuilding your business from scratch.
So the underwriter solves their margin problem by slowly transforming the independent agent from a free agent partner into a captive software user. Okay, so knowing all of this, the commercial reliance, the margin squeeze, and this aggressive push toward proprietary AI lock-in. So what does this all mean? What does an independent agent actually do about it on Monday morning?
Well, you can't just ignore the technology, but you can't blindly surrender to it either. You need a highly defensive operating strategy. Based on the strategic signals in these SEC filings, independent agents need to focus on 4 specific execution areas over the next 30 to 90 days.
Okay, let's hear them.
The first is building an underwriter scorecard to track effective economics.
Well, and let me push back on that. How does a small local agency have the leverage to demand anything from a multi-billion-dollar underwriter? The underwriter sets the terms.
Well, the underwriter sets the baseline split, yes, but the effective economic value of that underwriter is determined by the friction they introduce into your business. You have hidden leverage if you run a clean operation.
Friction costs money.
Exactly. Underwriters are hyper-focused on their own operational costs right now. If an underwriter gives you a great split, but their technology portals constantly crash, their underwriting counsel takes 3 days to return a phone call, and they bury your staff in redundant compliance audits, they are actively driving up your labor costs.
Right.
You must quantify that audit burden and the support response times. A slightly lower split from an underwriter with a seamless, low-friction infrastructure is often far more profitable for your agency at the end of the day.
That makes total sense. You aren't just measuring the cash they pay you, you are measuring the time they steal from your staff. What about the technology side? If we want to avoid the printer and ink trap, how should an agency approach these new AI tools?
This is the second execution area.
Hmm.
You must pilot AI defensively, implementing a strict human-in-the-loop protocol.
Human in the loop.
Yeah, you absolutely should leverage tools like AgentNet Assist for high-volume, low-ambiguity tasks like initial document indexing or data extraction. But you must actively measure the error rates.
Meaning you track the 30 minutes the AI allegedly saved you and compare it to the 45 minutes your senior examiner spent untangling a hallucination the AI has made about a property boundary.
Precisely. Because First American's own filings explicitly state that their AI is designed to support human judgment, not replace it. If the AI misses a break in the chain of title, the underwriter isn't going to take the blame. The liability for that misclaim still falls squarely on the independent agent's shoulders.
The agent is the one on the hook.
Always. Your human expertise is where the liability rests, which means your human expertise is where the value remains.
So use the automation to speed up the data entry, but do not let it make the final title determination. Moving to the revenue side of the playbook, that's number 3, right? If residential volume is frozen by 6.4% mortgage rates, how does a local residential shop actually pivot to capture the commercial growth we discussed earlier?
You have to invest in specialized commercial readiness if your local market supports it. You cannot process a complex commercial portfolio using the exact same workflows you use for a single-family subdivision.
It's just a totally different beast.
It is. You need searchers who understand commercial public records, staff who can review complex ALTA land surveys, and closers capable of coordinating multi-state transactions. Treating your existing staff to handle higher complexity files is a far better use of capital right now than spending marketing dollars trying to fight for the few residential purchase deals available in a stagnant market.
Yeah, fighting over crumbs. But if you are worried about vendor lock-in, that brings up the legal foundation of how you interact with these underwriters, which leads to the fourth and final area of execution, your agency agreements.
Yes. You must review the specific technology clauses in your underwriter contracts immediately. If you adopt an underwriter's proprietary platform for your escrow and production, you need to know exactly who owns the data you input.
You are basically looking for an exit strategy before you even sign on.
Yes, you need to verify data portability. If you terminate the relationship in 2 years, can you bulk export your customer data, your title plans, and your historical files in a readable format? Or does the underwriter hold that data hostage?
And what about fees?
Exactly. Are there hidden technology licensing fees that kick in if you fail to hit a certain premium volume? Preserving your operational independence means ensuring you can legally and technically walk away from their software if the relationship sours.
That is a phenomenal, concrete framework. Audit the friction, verify the AI, train for commercial complexity, and protect your data. Before we wrap up the playbook, there is one major regulatory issue lurking in the background that agents need a quick update on, which is the FinCEN rule.
Right. The Financial Crimes Enforcement Network, or FinCEN, issued a residential real estate reporting rule designed to track the beneficial owners of non-financed all-cash property purchases.
Just trying to stop money laundering.
Yeah. The mechanism of the rule was to force settlement agents to identify the actual human beings hiding behind anonymous LLCs buying up residential real estate.
But the court stepped in recently.
A federal court actually vacated the rule entirely on March 19, 2026, ruling that FinCEN overstepped its authority. However, the Department of Justice formally appealed that decision shortly after.
So for the independent agent listening right now, the rule is technically dead, but it's also a zombie that could wake up at any moment depending on the appellate court. What is the actual operational advice here?
The guidance is to hold the line. Because the rule is currently vacated, you are not required to file these beneficial ownership reports right now. However, because the DOJ appeal could theoretically reinstate the rule, you should not dismantle your compliance readiness.
Don't throw all your work away.
Right. Do not fire your compliance officer or scrap the software workflows you built to track LLC ownership. If the appellate court reverses the decision, the rule could snap back into effect rapidly, and agencies that completely abandon their preparations will be caught flat-footed.
Monitor the situation, but keep your armor on. I like that. Well, that perfectly encapsulates the entire operating environment right now. Let's briefly recap the mission we set out on today. We bypassed the surface-level narrative that the housing market is magically recovering. Instead, we dug into the mechanics of the Q2 2026 earnings.
And we saw that high-fee commercial files are artificially holding up the industry's top line. We broke down the agency volume paradox, showing how massive independent agent production is actively compressing underwriter margins.
Because you're keeping so much of the premium.
Exactly. And we explored the AI margin play, where underwriters are deploying optical character recognition and LLMs not just to speed up processing, but to entangle the independent agent within a proprietary ecosystem.
Understanding those mechanics gives you a massive strategic advantage over the agency owner who is just sitting around waiting for 3% interest rates to magically fall from the sky.
This raises an important question. Can you prove, with hard data, that your agency is a low-friction, high-margin partner? And are you legally protected if your underwriter decides their software is more valuable than your independence?
That's the real test. And I want to leave you with one final provocative thought to mull over as you run your business this week. It builds on everything we just discussed about vendor lock-in and the printer and ink analogy. If these underwriters successfully execute their vision, if their software ecosystems eventually handle all the complex search, the AI-driven examination, the automated fraud detection, and the escrow reconciliation, does the independent title agent of the future look less like a traditional specialized title professional and more like a localized sales, relationship, and risk management franchisee for a massive tech platform?
Yeah, it represents a total structural shift in what it means to be an independent agent.
It really does. Think back to that restaurant with the empty dining room we talked about at the beginning. If the underwriter is cooking all the food in the back and running the reservation software and managing the entire kitchen staff, are you actually the owner of the restaurant anymore? Or are you just the friendly host standing at the front door, greeting the guests as they walk in? Something to think about as you navigate this new landscape. But thank you for joining us on this deep dive. We'll see you next time.
In a world where change is the only constant, Mo Shamil stands at the forefront, guiding title professionals to not just grow their businesses, but to master the art of innovation. With every episode, you're handed the keys to unlock unparalleled growth and stay ahead of the curve. Get ready for a transformative journey